Hello, my name is Clive Corcoran and welcome to my YouTube channel. And in this video I'm going to look at options and I'm going to explore some of the key metrics or concepts involved with options, such as delta. I'll touch briefly on gamma, and what I will eventually demonstrate is why it can be useful and profitable to use deep in the money call options. Let us begin by talking about options on Apple. And when this is being recorded, as you can see here, this is the 20th of May 2025. I went to the Chicago Board Options Exchange, the platform, and searched for the current data for Apple, the shares of Apple, which, as you can see, when this was captured, were trading at 208. And I went and looked at one of the option chains going out into the future, and I selected this one, which is the September 2025 chain, and in this case this particular option expires on the 19th of September. And let us focus on the at the money strike. Now the share price is at 208. The nearest to that would be the 210 strike, and this is close enough for us to consider this the at the money strike for this particular expiration date. So you can see the strike is at 210, the share price at 208. And let us actually unpack what this shows based on the CBOE quotations. You can see that the last option, or the last call option at this strike, was done at $14 exactly. You can see the bid and the ask. These quotes are not necessarily synchronous because the last option might have been traded some time ago, whereas the share price, as can be seen, is actually the current price when this was being captured. You can see relatively low volume on this, and this is an important metric here. This is the implied volatility, which is sitting at 28%. This is not actually a constant, but that's another topic covered elsewhere on my YouTube channel. We can also see that the delta for this at the money strike is at 5477.5477. And essentially, when you are close to the at the money strike, this number will tend to be around 0.5, and this number has been explained elsewhere and has to do with what would be the change in the premium, the price, if, let's say, we were to increase the share price by a single dollar. And this is, as you can see, around 55 cents. There's a number here for gamma. We can see the open interest as well. So what I want to do now is I want to then take this data and compare this with the calculation that I've made by using an Excel workbook. I've copied across from the last slide. This is the at the money call that we talked about, the 210 strike. There's the $14, there's the delta and the implied volatility, as I mentioned. So what I have done is plug these numbers into a spreadsheet which I've created, and I've plugged in the relevant metrics into what is essentially the Black-Scholes-Merton pricing model, which is used to calculate the fair value for options. And let us plug in the numbers that we have been talking about. So we have a spot price of 208. That was the price of the shares of Apple. We have the strike at 210. We have the implied annual volatility to pick it up from there. The variance is simply that amount squared, so we don't need to calculate that. That's essentially given there for free, as it were. I've used a 5% discount rate, which is required in the Black-Scholes model because the strike gets discounted in line with the risk-free rate or discount rate. And then I've also done a calculation as to the amount of time between today, as it were, and when this option expires on the 19th of September. So there you can see that is the expiration date. This is today's date, in line with what I said, the 20th of May, and that corresponds to a year part of 0.33. So I plug 0.33 in here as the term, if you like, for this option. I'm going to assume a dividend yield of 0. And what we can see, the price for the call with these inputs, according to this model, comes out at $14.02, very close to what we see the price being quoted at. The last actually on that data from the CBOE was actually at $14. And you can see I've also calculated here the delta for that strike, the 210 strike, and it is 0.5491, which is again very close to the delta that was seen on the CBOE screen. So there is the call price, the $14.02, and we can also see the delta, which corresponds very closely to the amount shown on the CBOE screen. Okay, so let us now continue within the workbook that I've mentioned, the Excel workbook, which essentially provides a model based on the Black-Scholes-Merton formula as to how to calculate fair value for option prices. So to continue from where we were, we have this spot price for Apple of 208, and I'm going to use the 210 strike. The September expiration expires on the 19th of September. The current price, the spot price, based on this date here, the 20th of May, I've calculated the year part essentially between these two dates at 0.33, and I've plugged that into one of the inputs to the Black-Scholes model. We have the implied volatility as before, and as seen already, the fair value price for the call with those inputs to the model is $14.02. And I've also calculated the delta in some of the underlying logic, which I'm not actually explaining in this video. I've calculated the delta for those inputs at 55 cents effectively. You can see it here. In fact, this row here corresponds to exactly what we see on the screen here, 14.02 and the 55 cents. So if I take those two values there, and I copy them, and I paste them down here, paste the values into those cells, and you can see then if you add those together, the amount in this cell now is $14.57. And essentially that is what the premium would be if we were to increase the spot price as one of these inputs by $1. So let me do that. So I put 209. And as can be seen, the new price for the call with a higher spot price, $1 higher, is 14.57, which is exactly the same number here. So this demonstrates the useful feature of delta, because it does allow us to anticipate the change in the premium, the sensitivity of the premium effectively with regard to, in this case, a single dollar change in the spot price. What I want to do next is to see what happens if we choose an in-the-money strike. So let me maybe take initially this one here, the 160 strike. So I'll type in the 160 here. And as can be seen, the new price for this setup, where the only change I've made, all the others remain constant, is to reduce the strike. So this is now quite significantly in the money. In fact, there is $48 of intrinsic value, since the spot is $48 above the strike. We can also see this amount here based on this 51 spot 11. That's the call price. And there's in fact $3.11 above the intrinsic value, which we can actually call the extrinsic value. And by the way, what we can see over here is that for a variety of strikes, which I've already coded, you can see that, for example, this 250 strike, which is quite a way out of the money, this is quite a bit above the current spot, so this is an out of the money strike. we can see that the call price is very low. It's all taken up with the so-called extrinsic value. There's no intrinsic value. And we can also see the delta here at 17 cents. And what I actually can show you now, just bear in mind, you can see all these delta values here for these different strikes. I shall just move this into the diagram. What I did here was to essentially create a graphic which illustrates the relationship between the strike, as here on the horizontal axis, starting over here at 250 and all the way down, and the vertical scale represents the delta values as seen here. So in fact that is the 17 cents here corresponding to that. And one of the points to notice here is that as we move in this case to the right, and thereby as we're going more in the money as it were, the delta value approaches this value of 1 here. It never actually quite gets to 1, but gets very, very close. And the point being here that as you're deeply in the money, when you change the spot price by $1, it almost translates into a dollar move exactly in terms of the price of the option, the premium on the option. And this is why deep in the money options, call options in this case, are described as delta 1 products. I shall move this back out of the way for now. So with regard to a delta 1 product, as you are deeply in the money, the pricing of the derivative, the option in this case, tends to match dollar for dollar the pricing of the underlying, in this case the shares of Apple. Now let us look at a specific opportunity here with regard to using an in-the-money option. And by the way, a point that I want to make is that this video has been prepared for educational purposes, to give understanding of the topic I'm discussing, the nature of these in-the-money options and so on. I am not making any trading recommendations or endorsing any particular strategy here. It is, as I say, for educational purposes. So now we can see we have a strike here at 160, which we can see we have picked up here. The spot is still at 208. Now the premium, or the price for this option, as we can see, is $51.11. Now if we're dealing with a lot, a standard lot for an exchange traded option, we know that that involves 100 shares of the underlying. So if you were to buy one lot essentially on this expiration with that strike, it would in fact cost $5,111, the number there. Whereas let's supposing you were to buy the shares of Apple, 100 shares, the equivalent. As can be seen, that would involve an outlay of $20,800. So the thing to notice quite significantly here is that that outlay for the one option lot is only around 25% of what it would cost to buy the 100 shares of Apple. That clearly is a benefit because you effectively get to control 100 shares via the option at a much reduced outlay, in fact around 25%. Now what I want to show next is what happens if, let us suppose that in the future, sometime between here and here, the price of the shares of Apple go, let's say, to $240. I've just selected that number. In fact, in the fairly recent past, Apple has actually traded even at $250 or thereabouts. So we're looking at the future price for the shares of 240. Well, let's consider the comparative P&L for these two different positions. The P&L for the option trade is $28.89 per share, as it were. First of all, we need to calculate the break-even for this particular option. So the way we do that is to take the strike and add the premium. this gives us this value here, 211.11. And the P&L, therefore, is the difference between this price and this price, which is $28.89. And to translate that into a standard lot, that would be multiplied by 100, so we get 2,889. Now, if we consider that return, 28.89 against our outlay, this generates a P&L or gain of 56%. Whereas for the shares, if you own the 100 shares, you have in fact gained 3,200. And if you express that against the outlay, this equates to a 15% return. So clearly there is a better return, and bear in mind the much reduced outlay, which in a sense is complementary to what I'm saying. This is a 57% return against essentially a 15% return over here. Now let us just experiment with one or two other possibilities. Let us maybe suggest now that the strike be set at, say, 180, which of course again is in the money. This is now $28 of intrinsic value. And once again, we can make the comparison as I did over here. The price on the shares doesn't change because I haven't changed the expected future price, so that stays the same. But the gain that we have from the option position is now 79%. Now, the final point I want to make, of course, is let's supposing things don't work out so well at all. Let's take a rather bleak scenario. Let's say that the value, let's say on the expiration, has now dropped to, well, let's say make it 140 as opposed to 240. Now, the difference here is quite important. We do get the benefit of the leverage with regard to the upside potential. But somewhat unusually, and this is an interesting feature of options, our exposure from a leverage point of view on the downside is capped. We lose the premium. We lose the $3,350 that we paid for the option. But that's all we lose. We don't lose any more. The only risk you take when you buy options is that you lose the premium. So that effectively has gone, so it's a $3,300 loss. However, for the purchaser of the shares, their loss actually is $6,800 under these conditions, and that actually represents a roughly 33% loss. The key point to take away is that leverage is quite an important concept here, and it certainly benefits the option trader when things work out and we go way above the point at which we entered. But on the other hand, on the downside, there is obviously clearly a significant loss to, in this case, the option trader, but it is limited to the premium. And as we can see over here, for the purchaser of the shares, their loss is more substantial, of course, and as this number goes even further down, this number theoretically could actually go all the way down to 0. So I hope you found that interesting and useful. And could I encourage you to revisit my YouTube channel and subscribe, because I'm adding videos all of the time along similar ideas, which I hope you will also find interesting. Thank you very much for watching.